Imagine waking up, you finish your meditation, you open up your favorite social media app, and it's plastered all over the timeline. America has paid off the national debt finally. No more interest payments, no more debt clock. We're free. That would be the best case scenario, right? Well, not so fast. We're going to test that idea, and I think the answer is going to change the way you look at money, power, and safety. Welcome to Moral of the Money, where we turn big economic questions into practical wisdom. And the essential question for today is, what if the U.S. paid off its debt completely? I'm going to show you what that actually means, what would break if that happens, and what it would feel like for regular people, for businesses, and for markets if the debt was completely wiped out. All right, so we're going to level set really quickly. Before we dive in, cash. Cash means, in this context, the physical dollars you have in your wallet. Bank money, your checking and your savings. That's those zeros that are on the screen in your bank account. And treasury bonds, also called treasuries. These are the IOUs the government sells to raise money, and they pay interest on those IOUs. So in short, the national debt is the sum total of all the treasuries that the government issues. And in order for the government to pay off its debt, it would have to buy those IOUs or those treasuries back and stop selling new ones. If you're asking, why does the government have to issue IOUs in order to operate? Well, that's because the government typically spends more than it brings in tax revenue. And because the government is running this spending deficit, it makes up the difference by issuing debt in the form of treasuries. And over time, this treasury debt piles up, and now we're at the $38 trillion of national debt at the time of the recording of this video. So to explore this idea of what it would look like for the government to pay down its debt, let's explore two scenarios. In scenario one, the government increases its taxes so that it's running a surplus every year. So it's bringing in more than it's spending. And at the end of every year, whatever money is left after government spending, the government would use that money to buy back treasuries. So over time, the treasuries will be removed from the system. So what does that feel like in the real world? Well, if the government is raising taxes and we're paying more taxes each year, we're taking that money out of our checking and savings accounts to pay those taxes. So there's less money in the private economy. Now that's money that could be used for, it could just be used for savings, right? Just collecting interest, compounding over time. It's money that could be used for investment as well. So in theory, if taxes are increasing and we have less money in our accounts, then spending would slow down. Businesses have less money to invest in resources and new equipment. So hiring cools, productivity could cool, and then a recession is more likely. Now, this assumes that somehow the money that's being taken from our accounts to pay our taxes isn't replaced, say, by bank lending. So banks, again, when they lend you money, the money isn't sitting in someone's vault. For every dollar that a bank has in a vault, they can lend out several dollars, 9, 10, in some cases more dollars for every dollar they hold. So the bank is literally creating money out of thin air. And so unless the banks increase their lending, when we start to pay more taxes, there's just less money in circulation in the economy. And that typically correlates with an economic slowdown because, again, less goods and services are being purchased, less investment is being made, etc. In addition to individuals like you and I, investors, small businesses that would feel the pinch of paying more taxes, you have to think about pension funds, insurance companies, money market funds as well. These big entities buy a lot of treasuries because they hold their value in these assets that are considered safe that also earn interest. You want to retire and have your pension available. If there's a calamity, you want the insurer to be able to pay whatever, damages you incurred. And so these companies, these entities put their money in treasuries because they want the money to be there when it's time for you to retire. They want it to be there if you have an event that requires insurance. If it's a money market fund, you want your money to be there to pull out if you want to invest. And so if these entities don't have a safe place to put their or your capital, then they're going to have to seek out riskier ways to earn yield, maybe buying stocks or something else. That adds more risk to the system with your retirement, with the safety of your home or your car or whatever else you might be insuring. So that's something also to consider. Now, scenario 2 is kind of the opposite. In scenario 2, we would be converting the government treasuries or bonds into cash or currency. So in this scenario, the central bank would buy all the treasuries and credit everyone's account with new bank money. This is what you will hear people refer to as printing money. Now, it's not literally physically printing a lot of bills. It's when the treasury literally just zaps money into your account and you can see more zeros in your bank account, but you don't necessarily have more dollars, more physical cash in your wallet. Now, this one seems probably the simplest, right? Type on your keyboard, zap some zeros, the debt is gone. Well, the issue is now that you've taken the treasuries away, they earn interest, they earn yield, and you've replaced it for cash that really does nothing. You know, as I've said so many times, cash is trash. Not to mention, you have flooded the system with a lot of extra dollars. So if you've been following this channel, you know if more dollars are injected into the economy, that typically means more, inflation. Now, the caveat is if the economy is booming. So if you're adding more dollars to the system, but the system in and of itself is growing, our economy is growing, businesses are thriving, we're making more goods and services, and so there's more items, there's more services for these dollars to flow to, then there's not necessarily going to be more inflation, because with more dollars, there is more productivity. There are more places for those dollars to go. But if the economy is stagnant or shrinking and there are fewer places for those dollars to go relative to the increased amount of dollars in the system, that's when you start to get inflationary pressure, because you have more dollars headed towards the same goods and services, which makes the nominal value of those goods and services increase. Looking at our economy right now, looking at how the job market is contracting, we're continuing to see revisions in the number of jobs that are being added to the economy to now they're negative numbers every month. When you're looking at factors like that, we're in an economy that does not seem to be expanding or booming to the degree that if, say, the government started an aggressive debt reduction program, printing money and flooding the system to buy treasuries back, in this environment, that could be highly detrimental, because it could definitely be inflationary based on how the economy is performing. So scenario 1 removes money from the system and potentially causes recession. Scenario 2 floods the system with money and potentially causes inflation, and in severe cases, hyperinflation. It sounds like a catch-22, and it actually is. And the part that I think a lot of folks miss is that this is allowed to persist because treasuries are more than just IOUs, and especially U.S. treasuries. They're the backbone of the global financial system, and it's been that way for decades. China or any other country, when they've had to trade, they need dollars. So where do they stash their dollars? If they're waiting to trade something, they would stash them in treasuries and earn a yield in an asset that's considered the safest in the world. So because of the dollar's status as the world reserve currency, it has created a tremendous amount of demand for these treasuries. And there's been incentive for the U.S. to increase the debt. So if treasuries were to vanish, you're not just removing the debt, you're removing like the plumbing, the main safety gear of the global economic system. So you remove those, you have to replace them with something else. And we're going to explore what that might look like in another video because some other countries have been dumping treasuries. So it'll be interesting to track that. Life is typically a zero-sum game. So if someone is winning, someone is typically losing. In the scenario where the US government pays off its debt, who's winning and who's losing? So winning side, the Treasury. The Treasury, they're not paying out interest. So their budget looks lighter on paper. Everything is great. Now the trade-off or the losers would be retirees. Your money is sitting in a pension earning interest. If there are no treasuries, where are you going to earn that interest? Where's going to be the safe source of income so that the pensions can keep up with inflation? Banks. Banks typically use treasuries as their principal form of collateral when they're lending. If there's no other collateral to replace them that feels super safe, lending, what are they going to do? Is lending going to dry up? And then the private economy, you and I. Again, scenario one, money's taken out of the system. We're looking at potential recession, contraction, fewer jobs. Scenario two, money floods the system. We're looking at potentially inflationary environment where we get less goods and services for every one of our dollars. And even in the scenario of the Treasury winning, just think about all of the losers on the other side. If the Treasury's not paying out interest, everyone who has money in or had money in a treasury, in a bond, who was counting on the income they were earning from interest, all of that income has now dried up from everybody all over the world using treasuries. And that can't be good. The scriptures teach us that it's better to be a lender than a debtor. But when looking at this scenario, it seems like the United States is in a better position being a debtor than a lender. Well, one reason I think for that is the biblical principle is based on sound money. So a fixed supply or a scarce supply of gold and silver as money. And when you have sound money or sound monetary policy like that, where you can't just create money out of thin air, it keeps you honest. It keeps you from spending too much, and it forces you to make sound decisions about saving, spending, and investing. But when you remove sound money as the foundation for the economic system, like the United States and other countries have done when they created fiat currencies, you literally flip the principle on its head and you create a system, you create an environment that is much riskier and it's not sustainable. And that's why at some point, every economy that has a fiat currency implodes because you can't run deficits infinitely. At some point, something is going to break to the point where it cannot be repaired. The silver lining is on an individual level, we can be good stewards of our finances, good stewards of our debt, good stewards of the amount of income we bring in versus the amount of money that we spend. After this analysis, there are 3 takeaways that I am pulling from it. Number 1 is diversification. You want to have some money in cash for flexibility. You want some high quality assets for income, like say for instance, dividend paying stocks. And then you also want some real assets that hedge for inflation like gold, silver, or maybe real estate. Takeaway number 2, policy signals. If I hear big surpluses, then I'm thinking, okay, they're increasing taxes. There might be recessionary risk. If I'm thinking of how to invest, what does good in a recession? On the flip side, if the government is talking, say, quantitative easing and buying back a lot of the debt, then I'm thinking, inflationary risk. Where should I position my portfolio in that type of environment? And then number 3, a focus on productivity. No matter what, the long-term cure for debt is increasing your output. So improving your skill set, starting a business, even building relationships in your community, all increase your output, your productivity, and they offset debt in the long term. So could America pay off the debt? Technically, yes, but you don't get a free lunch. So you either drain the economy and cause recessionary risk, or you flood the economy and cause inflationary risk. And in either case, you're decreasing stability. So in the case of debt-based fiat systems, the goal isn't zero debt, it's healthy debt. So having a healthy debt to GDP ratio, which the United States doesn't have right now. So stay tuned for a near future video where we explore the current debt to GDP ratio and what that could possibly be signaling for the US. And if you like this type of analysis, if you like this type of commentary, make sure that you like, you share, subscribe, and also leave me a comment, because I actually love to hear your thoughts and your takeaways and what's on your mind. So I'll see you in the comments and on the next video.